James, thank you so much for joining. Tell everyone who you are.
Hi, I'm James Courtney. I'm the CEO and founder of a company called Lux Rewards. Been running the business since I started it, aged 21 at university, and been running it ever since for about 7 years now.
Nice. And how would you sum up that 7-year journey? Has it been what you expected? Has it been different?
Yeah, I'm trying not to use the word roller coaster or ups and downs, but yeah, or journey, which is about what I was just about to say. But it's been an experience. I hoped it would be a faster route to success. Definitely some challenges in the first kind of 4 or 5 years. But recently the business has really turned around and is on a really good path now. So yeah, very excited for what's to come.
Amazing. So tell us, what does the business actually do?
So Lux Rewards is a B2B business, and we promote merchant offers, so like cashback offers to over 30 million payment cards across the UK and the US. So we partner with banks, airlines, employee benefit platforms, and other large companies to power their reward schemes and their cashback programs.
Cool. And what sort of size are you at in team and revenue?
Well, our growth has been really strong. So our team size is still kind of catching up. We had our first month, last month, of £200,000 of revenue and beyond. So that's grown from 0 at the point of the pandemic up until now. Wow. So team size, we're about 8, but by this time next year, we should be about 30, 35 people. And then revenue now, is between £200,000 and £300,000 a month.
That's recurring.
Yeah, because it's transactional revenue, it's not as guaranteed as SaaS revenue, but it's pretty much recurring. Yeah.
Wow, nice. All right, so lots to understand. So 7-year journey.
Yes.
Take us right back to the start. How did you come up with the idea, and where did that come from?
So the very original concept was actually around hospitality. So as a student, I was a keen user of a company called Tastecard that you may have come across.
Yes,
so I was getting,
love it.
Yeah, as a student, for my sins, I was getting 50% off at pizza restaurants and other casual restaurants, drinking tap water, and then probably not tipping very well considering my non-income at the time. I was a real avid user of it and loved it, and still to this day think it's a very good business, and it went on to be sold for a lot of money. And so I kind of wanted to emulate that success. But what I spotted was a gap in the market. So I was working at IBM, PwC, Unilever, and a few other companies where suddenly I was earning a bit of a better salary personally. But more importantly, I was traveling with business, having an expense account, wining and dining clients, and suddenly realized that, yes, Tastecard wasn't quite as suitable. You couldn't really take a client to a Nando's or a Pizza Express. Mm-hmm. And likewise, when I did it once, took a girl on a date using a Tastecard, and it never again, let's put it that way. So I spotted an opportunity for a slightly more premium alternative to discounting, and how that could actually benefit both sides. So both for these kind of slightly higher spending customers that they currently weren't being rewarded at all for their purchases, and actually there could be a lot of value there, just like they get for their flights, for their hotels, for their credit cards. Why not dining? And then from the restaurant point of view, I was realizing when I was going out as a consultant and there was 20 of us on a project on a Monday night spending £50, £60 a head, that's actually half that restaurant's revenue for the evening. And wouldn't they love to get more customers like us? So that was the original concept, was a premium points-based reward scheme specifically for high-end restaurants and bars.
Nice. And you came up with that idea through university? Was that post-university?
Yeah, so I worked for IBM pre-university, which was a really interesting experience.
Traineeship, or what was?
Yeah, it was a pre-university program, so it was for people who were going on to university to do a year before they started, and I think it was part of their strategy to engage talented people early on in their careers, because it gets very competitive when you graduate. Yeah. A lot of companies are spending £10,000-20,000 per graduate through the whole hiring process. And so actually if they could engage us at an early age, then they could kind of then hopefully bring us back during our studies and then on as graduates later on. But it was a fantastic experience as an 18-year-old without any real job experience to move up to London from my rural village upbringing in between Bristol and Bath, to suddenly experience the the world of work and London life, and I had an incredible manager there at IBM who took the shackles off and got me involved in some really creative and innovative projects, and he actually ended up becoming one of our first investors as well.
Nice.
Later down the line. So yeah, great experience.
Awesome. So you go to university where?
So yeah, after my year at IBM, I then went to university in Bath. So not too far from home, but had a really good course there. And as part of that course, there were 2 6-month work placements, which is one of the reasons I was attracted to it. So I worked at Unilever and IBM, but actually for the second 6-month period, that's where I managed to persuade them to not go down the corporate route, but to let me start up my own business. And that's where kind of Lux was born. So I had a 6-month period where I had to get the product out there, get some validation, get the first early customers, and raise our first investment round. Because I already had a grad job, I wanted to start up my own business, but it's quite difficult to turn down, a decent grad job. So I wanted to secure that investment before finishing university to kind of put me on that path.
Nice. Okay, so universities are sometimes difficult to change the way that they do things. From personal experience, how did you convince them to let you change the course of what you were doing and building your own startup versus going into placement?
Yeah, I mean, all credit to the team at the University of Bath, actually. It wasn't as hard as I think it would have been at some other universities. Some very forward-thinking individuals there. And the main thing that I got from university was less necessarily about the studies, but more about the extracurriculum entrepreneurship activities that they had there. So they had a business plan competition, they had a apps crunch competition, they had a Dragon's Den competition, lots of networking and support and events, and it was kind of through that I was able to gain kind of the mentorship and the approval to take this forwards, really.
And you actually raised money from when we caught up earlier. So how much did you raise through that university 6-month period?
Yeah, so during university, I was live on Crowdcube.
Yeah.
So as Lux Rewards, we raised £82,000 for our first round. So as a 21-year-old at the time, full-time studies and having a 6-month window, I was pretty happy with that experience. We actually closed that round whilst I was out in America. I was fortunate enough to win the University of Bath business plan competition, and the prize for that was that they flew me and some other entrepreneurs out to New York, San Francisco and Boston to meet alumni who are in entrepreneurship, but also at Google and Facebook and other places like that. So it was quite the 6 months, I have to say.
That's awesome. So the fundraising, a lot of founders I meet are kind of weighing up, do I raise, do I not raise? That was, I guess, through a crowdfunding platform? Yeah,
so Crowdcube is a type of equity crowdfunding, which is much more common in Europe, much less common in the US because they have tighter regulations. If anyone's watched Wolf of Wall Street, it's probably around the kind of penny stocks and how they were misused back in the day, that their regulators are much tighter on it. But in the UK in particular, and now in Europe, equity crowdfunding is seen as an amazing source of finance. I didn't come from a particularly posh or wealthy kind of background, so the friends and family round wouldn't stretch quite as far. And so I think these kind of equity crowdfunding platforms can be a great way to open up access to entrepreneurs from all different backgrounds, state school backgrounds and different class backgrounds to be able to access funding. And so I had, friends and family, some put in from £10, some put in a few £1,000, as well as quite a few angel investors that I'd met during that kind of 6-month period put in. And eventually that got up to that £82,000 number, and they received equity, so a share of my business in exchange for their investment.
Okay, so you've now raised money. You have to go back to university to finish the degree?
Yes.
So
a tricky one, yes. Fortunately, the academic side I handled without too many difficulties, and there wasn't too much contact time and things like that. So we brought on the first kind of 2 or 3 employees whilst I was in my final year, and we launched the product properly out into the market. We initially started with in Bath and then moved on to Bristol during my final year. And then once I graduated, then I moved into running the business full time.
Okay. How did you manage all of that? Because that sounds like a huge amount of work.
I mean, it still feels now like a passion project, but even more so at that point, it really didn't feel like work at all. I mean, when I was writing the business plan for Lux, that was whilst I was doing a full-time job at Unilever. And so that was, late into the night doing it, but it really didn't feel like work. I think that initial kind of 6 to 12 months, if you're really passionate about it, it's just electrifying. It doesn't feel like work. It's, every waking minute you're thinking, oh, how can I do this? What's the marketing strategy? How am I going to differentiate all of these different parts? So, for me, it was almost a hobby at that point, and nice. I just, threw myself into it.
Awesome. So you leave uni. Have you got any clients at that point, or how far into the funding have you gone? Kind of what's going through your mind at that point?
Yeah, so during the 6 months placement, that's when we raised the investment. So we got the £82,000, and we also had our first 10 restaurants sign up. And that was just in Bath. And then through my final year, we hired a few people. We expanded into Bristol as well as Bath. And so, by the time I graduated, we had done our first fundraising round, and we probably had 30 to 50 restaurants signed up.
Nice. Okay, so tell me from there. So you've now got your first clients. You're, on a great trajectory. What happened over the next few years?
So that's when it became a bit challenging, really, and you could say it was humbling, but I think it was worse than that. Really, there was some real kind of real struggles throughout those first few years. Where fortunately I had very good friends and family and a good support network, but really, and I mean this not in a braggy way at all, but academia I did quite well in, and so I'd kind of been successful up until this point, and also had some jobs at IBM and other places which also went really well. So I was on this real high, thinking I could kind of take over the world, and then the reality set in, which is running a business is not easy. I was a solo founder at the time. Something which I wouldn't recommend. I actually think it's a really crucial part of starting a business, especially if you're a first-time founder, is to build a really strong, capable, well-balanced leadership team, co-founding team from the early months. And so, we faced quite a few challenges. The main one, really, looking back, was that our customer acquisition cost was too high. Essentially, once we got a user all the way through the funnel, so £1 a click, but then how many of them download the app, register, and then link a payment card? At every point you're trebling the cost, and it ended up being £15 to £20 a user. And as much as I'd grown up watching Dragon's Den and seeing people raise £80,000, £100,000, thinking that was a life-changing amount, it may be on a personal level, but for a business, that's actually a very small sum to raise. If you think how many people you could actually employ with that amount of money, it's not that sizable. So we kind of got stuck in this loop of raising relatively small rounds, most in that kind of 60 to £100,000 range every 9 to 12 months. And that was really tiring, to be honest, because what would happen is we'd already probably spent some of the investment money before we closed it. And then it takes about 6 months to raise an investment round. And so we maybe had 3 months before I needed to raise again. And it's the founder. If there's just one of you, it's just you going out and having to speak to angels, speak to funds, that type of thing. And so it takes up a huge amount of time, and you don't actually have time to grow the business. So you're trying to, kind of stuck in this perceptual cycle of raising and then not having enough to deploy to get enough growth to then kick on to the next stage. And I do think sometimes there's a bit of a gap between these kind of angel investors often coming in with 5 to 10k a piece. You might get one lead investor at 30 to 50, and so your whole round gets to about 100. There's a gap between that and then VC funds that come in and maybe at 500,000 raise and often 1 to 2 million raise, and sometimes businesses can get stuck in that gap, and that's definitely where we found ourselves.
So what would be your advice to founders that are maybe considering that early stage raise? How would you reflect back on that experience to maybe give some perspective of what to think about or maybe what not to think about?
Yeah, there's so many things that I would do differently, and for my next businesses in the future, I'm really excited to do it right this time. So hopefully anyone listening can pick up on these tips. The first would be to build a strong co-founding team from the start. Ideally, at least 3 people, and ideally with quite balanced skill sets, so with different skills. At the moment, I've got 2 co-founders, and one is very detailed ops oriented, and the other is much more kind of creative and also on the sales side. And so we kind of match our skill sets really nicely, and we can make decisions as a team. I found it really difficult as a solo founder. I could make decisions, but they would weigh on me a little bit longer. You'd sometimes, for the months to come, have a bit of self-doubt. Whereas I find when you make a decision as a group, you can really just go full steam ahead with that idea. I would also mention, if you're building a tech startup, you need at least 1 technical co-founder in there. Ideally, maybe even 2 or 3, to allow you to get products out into the market quickly, to go through that test, measure and learn process, and iterate on that product as quickly as possible. We had amazing support from our development agency, but on reflection, I wouldn't go down that route again. I would try and have that as part of the co-founding team.
Are you a technical founder?
I'm not myself,
No. Okay.
and nor are my 2 co-founders now, but that's definitely something that I would do if I was to start again, because it allows you. Development is one of the most expensive things for a tech startup. So if you're able to cut out that cost in the early years, but still really focus on it and have high quality technical people be super focused on making this as incredible as possible in-house, that's invaluable. I would also say, from my experience trying to raise venture capital, that again, if you're a technical business, having a technical co-founder or 2 that have great credentials and can speak about how you're building that defensive moat or building that USP is invaluable as well. So that would be my first tip, would be build a co-founding team, and if it's a tech business, have a technical co-founder in there. The second would be not to rush to investment or rush to revenue. Both things that, as a first-time founder, I was like, wow, let's earn that first pound, and let's raise some money so we can grow this into an amazing thing. But on reflection, again, I think we did both of those things too early. And actually, if you look at businesses that raise quite a lot of money, or go on to make quite a lot of revenue, that curve can be quite rapid. And so that there shouldn't be a rush to do it, because once the clock starts on that revenue, or once you've raised your first pound of investment, there's then other kind of pressures that come into it, and you maybe don't always focus on the right thing. So if I was to do it again, I would consider being in stealth mode for much longer, and building up customers and getting kind of commitments before necessarily launching something into the market and making money from it. I also think the same with investment. Once you've raised investment, you want to spend it, and really what you want to do is not get stuck into this cycle of doing small raises. And ideally you want to take it as far as possible without raising a small amount, or at least having some kind of growth curve in there so you can raise a much higher amount.
No, I love that. I think it's very interesting, like when you talk about the challenges of being a founder coming out of university. So I had a similar experience. I did well at university, did well at school, launched a business, and all of a sudden, solo founder, the world comes crashing in on what am I going to go on and do? Like, what does success look like? The pressure of friends and family that may have invested or have been there to support. How did you overcome some of those challenges? So what was it that you were facing, and beyond obviously the fundraising, on a emotional and personal level, like how did you overcome them? Because I think you mentioned friends and family were very important. I would love to hear a little bit more.
Yeah, I mean, people talk a lot about opportunity cost, and there were times where I was doubting whether I'd made the right decision. I'd been offered a very good graduate job. The course that I went to at Bath, the business management course, had a lot of very successful people on it. So people were going out and, some within a year or two were on six figures of salary.
Yeah.
People that, I aligned myself with and thought I was of a similar ability to. And meanwhile, I was there at some stages paying myself nothing, at some stages paying myself 20,000 or something a year, thinking, what am I doing? And sometimes this was, I was getting 3-4 years in, and it was very wearing at times. Like I say, that I'd say raising the investment, repeatedly going through that process and not raising quite as much as we needed or wanted. That process was very wearing, because you have to, when you're doing an investment round, your heart and soul goes into it, and you work long hours, especially when it's on a public forum like Crowdcube or Angel's Den. We used both of those platforms, and it's public, right? It's public failure if you don't raise. If somebody asks a question on the forum at 11 p.m. at night, if there's going to be people worldwide that might want to invest, that question's going to be up there for 12 hours if you go to bed. So you're kind of working away really hard on it, and it was very draining. So what made me stick at it? I mean, there was the inspiration of my dad running 7 or 8 of his own businesses now. I've seen him go through ups and downs and come out the other side with success. So that's, it has always been my ambition to start my own business. But equally, I have a really strong support network. I also feel like I'm quite a resilient person. Everyone has, strengths and weaknesses. But fortunately, one of my strengths is resilience, and I'm able to kind of not take the downs to heart too much. Have that self-belief and press on as well.
That's good.
And that's my advice to anyone who's looking to start their own business. When they come and chat to me privately, the warts and all story is not a happy one. And for quite a lot of people out there, doing a normal job, not taking on this huge financial risk and all of the pressures that it entails, is the right thing to do. I think there has been a glorification sometimes of what it is to be an entrepreneur, on Instagram and other social media sites. But the reality can be really, really tough. It can be lonely. It can damage your mental health, sometimes physical health as well. So for me, there's huge upsides as well, and I love it. Yeah. We were speaking before we started the podcast, and I want to be doing this for the rest of my life. I've already got the next 4 or 5 ideas kind of mapped out. So hopefully you can hear in my voice. I love it. I'm super passionate, right? But it's not for everyone, and there's a lot of pain along the way.
Do you think there's a misconception that you start your business and within a couple of years you'll have that amazing fundraise and like that perception of what we see in places like TechCrunch or other media sites, like that's what the goal is, and maybe there's a little bit of a gap in between of the reality of being a founder, especially a first-time founder, as you mentioned? Like, do you feel that in the ecosystem?
Yeah, definitely. I think there is a misconception of how easy it's going to be. It also does depend on what type of business you're trying to launch. Yeah. And maybe if I was to do it again for my very first business, would I take on such a challenge that is the business that was started? I think maybe if you were to do like an e-commerce site or other types of businesses, some that might be considered kind of side hustles, they require less capital, so you don't need to raise. Yeah. You can often outsource, so you don't need to hire full-time employees. All of those elements make it, less cumbersome and less risky. So that might be a better way for people who haven't started a business before. Maybe take that approach. And there's a few businesses that I'm thinking about either in the future or on the side, where from the start I'm going, okay, this is a business that could be started and won't need employees until we get quite a long way down the journey, and won't need upfront investment. So I won't need to go out and raise. And taking those two parts out, I think, can make it a much easier journey.
Yeah. Okay. Love that. So sounds like a critical moment for you guys was COVID. What on earth happened there for the business? Because you almost, when we spoke earlier, you spoke about the business in 2 phases. So tell me about COVID and for the listeners, why that was such a pivotal moment.
Yeah, so for the first 4 years, as I mentioned, we had a number of challenges, and the main problem was that we didn't have enough of a marketing budget and the customer acquisition cost was too high. So we just weren't able to scale in that way.
And turnover roughly at that point for listeners?
Minimal, 10,000 a year even. Wow. At that point. We were really struggling to get off the ground. The weird piece is that when you looked at the lifetime value, because we want somebody linked to payment card, we were rewarding those transactions and getting that transaction data for 2, 3, 4 years in the future, and we were having barely any churn. Our lifetime value was actually really high. It was about £100. But the customer acquisition cost was £20-ish. And so for us to get 1 million customers, that's £20 million just for the marketing budget, let alone for anything else. And the payback period was about 12 months down the line. So we ended up being stuck in this point where we weren't able to grow one side of the market. So it was a bit chicken and egg. Now, I love two-sided markets as businesses, because when you crack it, they are very, very scalable businesses. However, you can end up in this chicken and eggs scenario where until you've got enough on one side, a critical mass, as it were, you then can't grow the other side. So a lot of businesses do this where they end up having to zigzag. Yeah. Or as I mentioned earlier, you do one geography and you constrain it either by geography or demographic or some other element. So that was the kind of struggle when I look back. That's why we weren't able to scale. Wish I'd realised that a bit faster, I must admit. But we were also kind of stuck in this perpetual loop of raising relatively small rounds of funding and then not having enough time to really deploy that and then having to raise again. So as horrendous as COVID was, it did allow me time to get off that kind of hamster wheel of raise, try and grow, and to assess the business as it was, see what we had of value, and then create a strategy for how to maximize that value going forwards. So we'd actually signed up about 300 restaurants and bars by that point to pay us commission, on average about 15%. So that has a lot of potential revenue there. And the only reason we weren't making much revenue from it was because we only had 1,000 users. So the thought process, and it seems very obvious now, was, okay, well, how can we grow the number of users into the hundreds of thousands or even millions without having to spend a huge amount of money on marketing? And the strategy we came up with was essentially B2B2C. Right. And so we looked at what businesses out there already had hundreds of thousands or millions of customers engaged in some kind of cashback or reward point program, and said, hang on a minute, why wouldn't they like our 300 restaurants and bars signed up? And fortunately, they did. So there's the market dynamics, as it has been for quite a few years, is that these businesses that start up reward and cashback programs don't want to hire their own team of salespeople to go around to restaurants, but also, and as we're now across multiple sectors, to go and speak to software companies and hardware companies and retail and e-commerce and all these different sectors. It's not cost effective for them to kind of hire and train that sales team for themselves, nor is it good for the merchant side, because they're having to sign up individual contracts with loads and loads of different banks, airlines, employee benefit platforms, cashback programs, and so forth. So there's a market opportunity, again, that I spotted there, which was, okay, we can essentially act as their sales team and be an intermediary between these two sides. And that can give us access to millions of customers. So we signed up our first bank, which went live in June 21, and that added 400,000 cards in one go. Wow. So that cost us nothing. And instantly we had 400,000 customers, which is mind-blowing, really. Incredible. It didn't feel real until it had actually gone live. Because over the years, you're always coming up with new strategies and you think, oh, this is the idea that's going to solve it. And often those hadn't gone quite as well as I'd hoped, despite my best efforts. But with this one, it really did. It kicked on. And all of those 400,000 users all had cards linked because it was a bank. So instantly, whenever any of them went into any of our restaurants or retailers or merchants, we would be getting, on average, 15% commission. Wow. So our revenue started on the upward trend from there.
The 300 restaurants must have been very happy.
They're very happy, yeah. And the opportunity just opened itself up, really. That bank had about 10 offers on their page to start off with. Within a year, we'd taken that to about 500 in total, and not just restaurants, but retailers, taxi companies, printing companies, stationery companies, a whole variety of different opportunities. Within 3 months of launching with that first bank, we'd gone live with our first airline, which had 5 million users.
Wow.
And then onwards from there, really. And we're now at a place where we have got over 30 million payment cards that we can promote offers to, primarily across the UK and the US. And you can imagine taking commission on all of those cards, now well over 500 merchants, more like 1,000. The revenues are moving in the right direction.
Amazing. I love that. So how on earth do you sign a bank though? Like, break that down for anyone listening that's their target account. How do you when you're I guess your revenue was like relatively small. How did you go in and convince them to trust you?
So yeah, with any enterprise contract, especially a regulated industry like banking, you would imagine your sales cycle would be 1 to 2 years.
Yeah.
And as you mentioned, for a small company, you may just not get the gig at all. Fortunately, we weren't really selling to them. It worked out that we were the ones paying them money, not the other way around, because we were signing up the restaurants and the retailers and the merchants. They were paying us the commission, and some of that would go through to the banks to give them some profit margin, but also go through to the customers to pay out the cashback. But it meant that we didn't need to go through this massive kind of vetting process or lengthy contract process with 20 stakeholders and everything, because we were actually providing them with revenue and providing their customers with value, and it was all funded by the merchants that we'd signed up.
Nice.
So that made it more like a 2-month process than a 2-year process.
So did the bank call you, or did you cold call the bank?
No, to be fair, we were the ones who reached out to the bank. So I guess we were kind of selling to them. But I guess in terms of the buyer-supplier side, it was switched around in that sense. It was weirdly easy to get in contact with the banks.
Cold emailing, calling?
Cold emailing and mostly LinkedIn. If someone's got head of partnerships or something similar in their name, their whole job is to form partnerships.
Amazing.
So those are my favorite people to speak to, whether it be on the merchant side or on the bank side, because your interests are aligned. They want to form partnerships. They want to drive value to their business. If I can provide that, then it's amazing. And for me, I think I'll always be going down the B2B route from now on with any of my future startup endeavors, because I'm not really a kind of brand marketing person, which is all about grabbing attention and eyeballs. And sometimes that means it's not actually the best product or the best value proposition that wins. It's who can get the most attention or who can time it right, or a variety of different aspects, but aspects that I'm not that strong at. Whereas with B2B, if you build a strong value proposition, as long as you can reach the right person and talk to about it, you tend to get better decision making. They'll properly weigh up the pros and cons. And if you've built a business that does drive value, often they'll say yes. So for me, B2B, as much as it may sound less interesting and not be quite as glitzy and glammy as consumer products and services, for me, it's the best way to run a business. If you can build that strong value proposition, you're on for a winner.
Nice. So would you call it a pivot? What happened through those months?
Yeah, a massive pivot, I would say, because we went from just being focused on restaurants and bars, so hospitality, and focused on growing a consumer app that we were putting out there through our own marketing, to a B2B company, essentially, where we were providing services to banks, airlines, employee benefit platforms, and other enterprises. So massive change in strategy. Still, I think with the same kind of goal in the end. So it wasn't a completely different business. We were still using quite a lot of the technology and the contracts with restaurants and other kind of assets that we'd built up over the early years of Lux to kind of launch ourselves into this new strategy. And we were able to essentially just monetize what we'd built up, just in a slightly different way.
So big strategy change. What else changed internally?
Because of COVID and furloughing and things, there was a 6 to 9 month period where I was able to kind of decompress, take time out. I moved back home, so back into the countryside, out of the hustle and bustle and busyness of London. Had some more time speaking to my dad and friends and family, and I was able to reassess the situation and come up with this strategy, and also kind of recharge the batteries, because I'd gone through, I think it was 4 or 5 investment rounds by that point, and I was juiced out. I was getting towards the end of my tether on it, but it came at the right time, and the new strategy really excited me. The remote working side actually worked really well for that during that period, because everyone's moving to Zoom, and actually a lot of the people in banking were had a lot more time on their hands. I was able to adapt as a younger person to use technology
better,
to my advantage and get more of those meetings in, do more lead generation, and instead of having to have lengthy face-to-face meetings or traveling about town, I was able to have 5 to 10 meetings a day with various different banks and airlines and so forth to kind of kick things off.
Nice. What about team? How did you change the team?
Yes, the team changed around that period from me being a solo founder and focused on signing up restaurants to my 2 co-founders now joining me in the business venture.
So you brought them in?
Brought them in, yeah.
Tell us about that.
Yeah, so really interesting experience. It's quite difficult to bring in co-founders later down the line.
Yeah.
So I would really advise anyone out there who's starting a business to get co-founders in right from the start, not to be precious. I've seen a lot of people where they've just come up with the idea themselves and they're like 1 month in to trying to make a reality, and they're already like, oh, well, I don't want to bring someone else in. No. You want to get them in as early as possible, and ideally, share the business equally at that stage if you can, because there's lots of statistics out there, but your chances of success are much higher. But even more importantly, your journey will be so much more enjoyable if you have other people to go through it with. And that's not there's nothing bad about saying that. You can be capable enough to make decisions yourself or run the business yourself. You can be an independent person. You can be someone confident of making decisions. It's still, in my opinion, much better to get co-founders in as part of that journey. In this scenario, we had 2 different scenarios. One, Tom Monday, my now chief commercial officer and co-founder, he reached out to me. He'd been working in startups for a while. He actually ran his own card-linked offers business in the nightlife sector. So he had exactly the same experience with me. I'd been going after restaurants. He'd been going after nightlife. His funding, unfortunately, had got pulled. But what an amazing person to literally have the exact right experience to come in to join. And then Ash Day, who's my other co-founder and now COO, he had a background at Accenture, so he's an absolute machine. That's why he's COO, right? He handles the day-to-day brilliantly, and he'd been running his own workplace wellbeing business, and we'd been in the same accelerator program together. Okay. Had similarly faced issues over COVID. Both our businesses has basically hit 0 revenue over COVID, because he was delivering workplace wellbeing sessions in the office, right? Nobody was in the office, and I was making money off people physically dining in restaurants, and nobody was doing that. So we met up in the late summer of 2020 to support each other, and we'd already formed a bit of a partnership together anyway. I put rewards into his his product at the time, and we saw the benefits of coming together, running the business together. And actually, the business that he kind of brought to the table was what funded us for that first kind of 6 to 12 months before our first bank deal on the reward side kicked on. So they went hand in hand, really.
Yeah, it's so refreshing to hear, because I meet a ton of founders that are solo founders, and they just think they're too far in to change. Like, we can't do it legally, investment, whatever has gone on. So how did you actually do it? Like, you said there were challenges. Was that like structural? Did you have to, lots of lawyers? Just for any founders that are listening thinking, wow, I didn't even know I could. How did you actually do that?
It was a lengthy process to merge the businesses. Essentially, when you merge, there is always an acquirer. So the reality was that the reward scheme business had raised more investment and got a bit further down the line. So we technically acquired the wellbeing platform, and their shareholders were given in exchange shares in the Lux Rewards business. But it was a relatively costly exercise. We managed to keep costs down as much as possible, but it did take 3 to 6 months and 5 to 10 grand in cost.
Okay.
And that's really at the lower end.
How did you keep that down so low?
Just by negotiating hard.
Nice.
With accountants and lawyers, and by doing quite a lot of the elements ourselves. Fortunately, as I mentioned, Ash is one of the most competent people I've ever met in my life. But together we were able to find ways to keep the costs down and manage the expectations of both of our shareholders. Fortunately, both sets of shareholders had basically written off their investment at this point. As I mentioned, both our revenues had hit zero and weren't in the most attractive COVID markets. So it was pretty easy to get them on side, and it's turned out to be an amazing decision to work together.
So you've literally gone from zero to now, I know you're over $1 million in recurring revenue if we look at it that way. You're flying, right? Or is there still things going on? Because again, like when you speak to founders, they think, well, when I get to that critical revenue, everything's going to be better.
Yes.
Is it?
I mean, for me, I love the day-to-day now. So from a personal point of view, the fact that we have enough money in the bank that if a mistake is made, we're not just going to go bankrupt. FU money is what some people might call it. And it's something where you do kind of, if you've got that reserve there, then you're able to take more bold decisions, and you won't be kept up at night by, if that doesn't go well, or that one merchant doesn't pay, we could go bankrupt next month. It's no longer am I, having sleepless nights about anything like that. So that's a big advantage. Also, I think the trajectory, because we're just on the up, I mean, pretty much every month is just up. It's a very exciting place to be. And even when things go wrong or there's challenges that come up, because we're on the up, it currently feels great. I can't speak about what could be the next phase at some point where that growth slows or a major challenge occurs. But at the moment, and as it has been for the last couple of years, I love working with my co-founders and my wider team. The business is being successful, and that feels very fulfilling. And it currently feels like the sky is the limit. Love that.
So you did raise some money, I think the end of last year?
It was actually this year, May of this year. So yeah, again, quite an interesting journey where we were trying to raise venture capital funds last year, in 2022, and that wasn't successful. So again, another kind of a blip on the map, right? Had the ups and downs, but the business was going really well. We were growing really nicely. We had these big bank contracts and airline contracts, and yet we still weren't able to get a venture capital round secured. We never even got to an investment committee. So, I mean, speaking objectively, it was an abject failure. I'm not gonna lie. You would hope to at least get to a few investment committees, and we had really good advice. I spoke to probably 40 to 50 VCs. I have some frustrations with the process.
Like what?
Well, I think if you look at the US, most people in VC are kind of operators or startup founders in the past, and so understand what to look for and what to look for in the individuals a bit more, and things. Whereas in Europe, from what I saw, a lot of it was more either career venture capitalists, or a lot of people at the early stage had just come straight out of university, I would say often from quite privileged backgrounds, suddenly assessing whether your business was viable or not in a half an hour call.
Yeah.
And so not that age is a thing, but I had people 6 months out of university, first job, assessing whether my business was viable. And I have some issues with that, really, in terms of how seriously are you taking the opportunity, and whether they really can understand whether it's viable or not. I also think it then becomes a bit of a game, right? If you don't actually understand what makes a business tick, then you, as a VC, you're just going to start looking at these numbers on the graph, and you take everything away from investing in the team, understanding whether this business really has growth potential. And I feel like a lot of early stage VCs were just kind of doing checkbox type exercises and not really seeing the potential behind the business. In fairness to them, there are obviously things that I could have done differently. We were still trying to grow month on month, so I did struggle sometimes to spread my time between keeping the business on the right track, on that growing path, and dedicating all of my time to just endlessly going out and networking with VCs and things like that. So there were some learnings from that side, and I think we could have done a better job at advancing the technology side of the business and really creating a kind of defensive moat out of our technology. So there were elements that I would look back on, but it was a long and fairly painful journey, spending roughly 9 months trying to raise VC money unsuccessfully.
Wow. So it's, again, super interesting because you've got this, perceived growth, that the numbers sound phenomenal, yet struggle to raise the capital. So what happens next?
Yeah, so we were in crisis mode at the start of this year. It honestly feels longer than that, but we were in a point where we just hit profitability. So we had our first profitable month ever in December of 22, and moving into the start of 23. So we did have a kind of self-sustainable business model, but it was precariously placed, and we would have liked to hire some more people because the burden on the co-founding team, there's only so many months or years where you can put 110% in and you get towards burning yourself out as a team. So we were then trying to decide, okay, do we just not raise at all and try and grow within ourselves? But the view was that we were probably burning ourselves out. Didn't want to go down that route. The other option was angel investment. Again, I was put off that by getting stuck in these cycles of smaller raises. Fortunately, and just to go back to it, but our final raise before COVID closed on the 18th of March 2020, and we raised 220,000. So there's definitely some luck along the way. We were very fortunate that if we'd started that process a month later, the business wouldn't exist today. But the other option was angel investment. Didn't want to go down that. Now, fortunately, we are a very partnership-friendly business, and so within the reward scheme space, there's obviously loads of different companies all doing different things. And one of our closest partners had just been acquired by another larger global reward scheme company. That partner was able to introduce us to this other company who are doing great things and on a really great trajectory as well for investment into the business. So we raised about £3 million of investment in May of this year.
Nice. Awesome. So what would be the advice to founders right now? Because I know a lot are struggling to raise. You've ended up finding this partner route. Was that intentional? Did you proactively outreach to get that, or how did that actually come about?
It was a bit fortunate. It's because this partner of ours had just been acquired by the business, so we were suddenly aware of them. aware that they were making big moves in the space, and that also they were, you know, well funded themselves and were looking to make more kind of investments and acquisitions. So it was opportunistic rather than necessarily planned, but the option obviously came across my desk, and it was, where do you put your time and focus? And with running your own startup, it's often you have 100 ideas a day, or, you know, many opportunities come up, and which ones do you spend your time on? And fortunately, I put, you know, all my eggs in that basket of raising via this company in the space, and since then, obviously, the investment came in, and the business has grown at an even faster rate. So
nice.
Really glad we did that.
And how do you plan to deploy the capital? Like, is that to extend your runway for a few years? Are you going to go super hard and aggressive in headcount, or what's planned?
Yeah, so it's interesting. We made a conscious decision not to go down the VC route anymore. So the VC route is obviously raise, but then you do your Series A, B, C, D, E, IPO time. You know, that's the kind of path. And VCs, for good reason, they need to have just a handful of businesses go on to IPO or get to unicorn status or so forth to pay back their entire funds. So their aim is to push. Doesn't matter if some or most fail along the way, as long as a few get there.
Yeah.
Whereas with the investment we've taken now, we did give up a larger percentage of our equity pool, but we're not looking to raise again. So I think that will have been our final round. We may be acquired by that company who invested us, or sell in and exit in some kind of other way in a few years' time. But yeah, we're now looking at that kind of sustainable growth, not hyper growth, even though at the moment we're almost accidentally kind of moving into that hyper growth stage where there's been months this year where we've just doubled revenue month on month.
Wow.
And that's recurring revenue. So it's really on that trajectory. But no, we're looking to probably bring in 5 people in the next 6 months in terms of employees. So we're being fairly modest in terms of how we're kind of deploying that capital and making sure that, the business is in a sustainable place.
Awesome. So it sounds like from the conversation, loads of critical moments on that journey over the last seven years. If you had to be critical of your own success or your work, like, how could you have done it better? I know you've mentioned the co-founder piece, but maybe even in the last couple of years when the revenue's been growing, how could you have done it better? And what advice could you share to other founders?
Yeah, really good question. I mean, if I was to do it all again and go all the way back to the start, there'd be so many things that I'd do differently. I think a lot of founders will read the Lean Startup and other similar kind of business books, but do you actually put it into practice? And a lot of people see the Lean Startup just as let's not spend as little money as possible to launch a business. And that's not really the essence of what they're saying. It's much more, it actually took 4 or 5 years to realize that the business wasn't successful in its current strategy. How could I have realized that within 3 months or 6 months? So those are some of the things that I would put in place. I would get a co-founding team. I would raise a bit later. I would build up customer bases and launch in a way where I become very attractive to VCs and investors because I've got a guaranteed revenue curve. There's a whole bunch of things I do there. More recently, and I think that's a good question because the business has been successful recently, but still, what could we do differently? And I think the main thing really was actually around hiring and onboarding team members. It was actually the event that we met at, where we were talking about hiring and how to build the culture of a team adequately. And over the years, we didn't have too much funding. And so what I'd ended up doing is essentially lowballing on salaries and not spending that much money on recruitment, and therefore not having a big pipeline of candidates, and being in a position where we made some bad hires over the years, and that wasted not just money, but it also wasted my time. It meant that the money we'd raised from investors that we needed to be productive to get out of this circle of continuous raising wasn't able to be deployed properly and generate the returns as much. And that has continued even in more recent years. And it's something where I'm pleased to say our last few employees have bedded in really nicely, and we've got the right type of people, and we now have a much more kind of standardized process, and we look much more at cultural fit, and we go through the process much more thoroughly. But yeah, that's definitely over the last 2 years, we've still, made some mistakes with our hiring. And I think, and from what I've been told, I mean, we're still only at about 8 people, but from what I've been told, the first kind of 10 to 20 people are the most crucial in the scaling journey. And so that's where I'm obsessing, and that me and my other co-founders are obsessing, is how can we build up that team of absolute superstars that are going to take this business forwards.
Nice. Awesome chatting to you. How can people find you, and where can they get access to the business?
Yeah, so you can reach me at james@luxrewards.co.uk. That's my email address, or luxrewards.co.uk is the website. You're welcome to connect with me on LinkedIn as well. Any founders that are just starting on their journey, or even just considering an idea, I really want to give back to the community. If anyone has any questions or wants any advice, really happy to kind of support wherever I can.
Amazing. Thanks so much.
Thank you.